So basically what we're gonna go over, just kind of the general high level idea of financing in the lending markets. A little mortgage fraud, mortgage loan products and basic guidelines, renovation loans, you probably heard of 2 or 3Ks, and kind of fixer-upper kind of loans that you're probably gonna be asked a lot about, especially for your investors and a lot of first-time home buyers that are watching HGTV and kind of, it's in their brain that they can go buy a house for 50 grand and put 50 grand into it and sell it for $500,000, that kind of stuff. And then the loan approval process, it's weird. So maybe it's go to a Mac, that's cool. Mortgage products, conventional, FHA, VA, USDA, and jumbo will kind of go into what the differences are, what the requirements are in regards to credit score, down payment requirements, some of the nuances of those products. So basically conventional, that's your first kind of loan that the majority, I would say probably 50 to 60% of the clients that I originate for go conventional. It's mainly for your borrowers that have a decent credit score, have some money in the bank, good job history, good income. It's not as lenient on the underwriting guidelines as your government loans. Normally 5 to 10% down is the minimum down payment on a conventional loan. You can go as little as 3%. There are some conventional financing out there that you can go 3%. And even there's zero down conventional loans out there as well. Certain banks offer what's called a CRA, it's called Community Reinvestment Act, where if you fall under a certain income threshold and it's in a certain area of Indiana, they actually extend 100% financing. But it's very rare. It used to be more prevalent when I started, where you can get 100% financing for a first-time home buyer or anybody for that matter. My first loan, when I think it was 2006, 2005 or 2006, it's called My Community. I got a zero down loan. And I had the money for the down payment, but I was a first time home buyer. We're just getting started in life with my family, and why not have kids born? But I want money in the bank in case things were to break. I'd rather have that money available to me as opposed to sticking it into a house. Because you put it into a house, you can't get it out if you need that emergency money, that equity, unless you pay somebody to refinance it or get it out of the house. So that product kind of went away, unfortunately. With the meltdown of 2008, 2009, lenders really shied away from those 100% financing on a conventional type of loan. 45% back-end ratio at 50% with extenuating circumstances. In English, that basically means your percentage of your monthly income versus your debt. So it's a ratio. Debt to income ratio, I'm kind of flipping it around. So it's all your monthly debt divided by your gross monthly income, which is cool. I get people all the time applying online, and I look at their income, and 9 times out of 10, I'm like, are you sure is that gross or net? Oh, it's net, that's after taxes, or after my 401k deductions and what have you. So it's always going to be your gross income, and that's how we qualify you for a mortgage. And then so the ratio is going to be all your minimum payments, so we pull a credit report, you're going to have your equity lines, whatever you have in your credit report, student loans, and we'll get into that in a second. Credit cards, installment loans, and then your estimated mortgage payment. So when we add all those up, and then basically, we want to be at about 45%. Anything above that for conventional, we got to kind of jump through some hoops. There's got to be some, it's kind of what we extenuating, compensating factors is a better way to term that. So say you're 50% back-end ratio, or you're 52 or 53, you're going conventional, but you have a lot of money in the bank. Great credit score, good job history. There's a good chance of those compensating factors making you able to go above or break that 45% debt to income ratio. So, and I always enjoy kind of working that number. That's not a number in stone. There's a lot of variables that we can do in order to, shuffle around debt, figure out ways to get the person to that 45% so we can qualify for a loan. That makes sense. For finance properties, what that basically means is conventional normally for a specific person, say you're an investor and you want to buy a bunch of rental properties. I have rental properties. I have a good amount of loans under my name. So most conventional, they do not want you to go over 4 mortgages at one time for any particular person. Okay. 5 to 10 case by case, same thing. If it's somebody that has experience managing rental properties, you can go up to 10 loans. I've seen a couple where I pull a credit report, and I got 10 mortgages on a credit report, one human being. So it's possible. Asked about minimum credit score. Normally, in the conventional loan world, you really need to be at about a 660 credit score for it to make sense to get a conventional loan. You could go 620. The problem is, in the conventional loan world, the interest rate is priced directly based upon your credit score. So if you have somebody with a 620 and they may qualify, say for example, today the rate is, right now we're right at about 475, 4625 for a 30-year fixed. The rate's gonna be about 5.5 to 6%. It's gonna be a huge adverse pricing adjustment because of a lower credit score. So it starts making sense when you start getting to that 660 range on a credit score. 4 years bankruptcy, what that basically means is the seasoning aspect of a bankruptcy. So in a conventional loan world, normally you need to wait 4 years if you file for bankruptcy from that discharge date in order to get a conventional loan. Chapter 7 bankruptcy. There's two different types of bankruptcies. There's Chapter 7 and there's Chapter 13. Chapter 13, where we hold off, it's a lot more lenient in Chapter 13, the seasoning. It's almost no seasoning sometimes. Chapter 13 is more of a debt restructuring program where the person says, hey, I'm running into financial issues. I want to take more responsibility. I want to pay my debt. So they restructure that debt for a more manageable payment. So an attorney negotiates. You probably see a lot of these commercials and billboards and credit repair and debt consolidation. That's a fancy word for Chapter 7 bankruptcy most of the time. So the attorney will go in and negotiate with the creditors and have one payment. So we would have to verify with the trustee or the attorney to confirm that they're making their payments as per the new agreement with all the new payments. So with a Chapter 13, it can be as little as 1 year in order. You could still be in a Chapter 13 bankruptcy and get a mortgage. It's possible. I've done it before. As long as they're making their payments on time. Chapter 7 is more of a bailout. That's a bailout. It's not a bailout. It's basically they wipe out all your debt. You're just like, you're in a situation where, hey, I'm completely underwater. I'm not even able to manage the minimum monthly payments. So Chapter 13 comes in and basically wipes out all your debt. A clean slate.
Does it include taxes?
What kind of taxes?
So you must do home tax.
So if you got like a tax lien, I believe you can include taxes in the bankruptcy now. You can include your Kohl's card and your mortgage and your car loans and what have you. I don't think you can include. I think that's more of a lien that I don't think can be satisfied through Chapter 7. So I could be wrong on that, but I don't. That's a good question. 5 to 7 for foreclosure. Okay, so when you're in a foreclosure situation, 9 times out of 10 with a conventional loan, you gotta wait 7 years. By the time that it's discharged, by the time the sheriff's sale is completed, and the title has transferred from the person that was in that house to the actual bank, when the bank takes over the property. You normally have to wait 7 years. It says 5 years. There are extenuating circumstances where, in a conventional loan world, it can be 5 years. Bankruptcy. So if you have a mortgage included in a bankruptcy, that's considered a foreclosure as well. If a Chapter 7 takes care of a mortgage in a bankruptcy, it's the same seasoning requirements. We consider that a foreclosure, just like you know that. Max loan amount, it keeps on going up. What I mean by that max loan amount for conventional right now is that it's based upon areas of Indiana, but right now it's about $484,000 for a max loan amount. And what that means is anything above 484, and you're probably going to see that in Zionsville, depends upon your market areas, it turns into a jumbo mortgage. And that's a different animal altogether. We can go into that. So the good news is, and probably in your spreadsheets there, I don't think you have one there, in your information packets here, I think last year when I did this, it was like 428 or something like that. So it's a good, when the economy's doing well, they justify lending out more money and jacking up that, because when houses are appreciating really fast, the loan amounts go up, what they're willing to accept. And then 3% down program available under certain circumstances for conventional. It's possible to get into a conventional loan with 3% down. a lot of them, you have to be a first-time home buyer. A lot of them have income caps where you can only make a certain amount of money, household income, in order to qualify for a 3% down conventional program. So I mean, it's just basically what I went over. You know, basically conventional, you know, if you have a high down payment, you know, you have good credit scores, we're able to kind of overlook a lot of these things if you're a seller borrower. You know, there's always, we got a bunch of rules, but there's always exceptions to rules. And I love finding those exceptions and helping people out as much as possible. I'm not that guy that's going to be turning people down and being a stickler. Obviously, I want to make it work for you guys and make it work for me. What we got? Shout it out.
3%.
There you go. You don't want lottery tickets, so you guys shout them out, and then I give you a lottery ticket.
Oh.
Yeah. This one, I haven't even talked about this yet.
B.
Yep.
Can't even read it.
4 years.
B.
This better be a winner.
It'll be one of them.
I can use.
Okay, so FHA, FHA is a loan, probably almost half the time I'm originating FHA loans. When you're on the internet and they're advertising first-time home buyer loans, I always get that question. You know, I want a first-time home buyer loan, and it's such a wide, you know, vague way of saying FHA 9 times out of 10. The internet pretty much says it's a first-time home buyer loan. The cool thing about FHA is that the minimum down payment is only 3.5% on an FHA loan, and the guidelines are a lot looser. Okay, it's easier to get your buyers into a house with an FHA loan if they're kind of on the border between qualifying. 2 years out of bankruptcy, Chapter 7. So they pretty much have to wait 2 years for an FHA loan before we can get them a loan if they had a bankruptcy. And again, Chapter 13, like I said before, Chapter 13 we can actually get you a loan in the middle of a Chapter 13 as long as you're making your payments on time. And you only got to wait 3 years on a foreclosure for FHA. So it's a lot more lenient of a loan. And again, that comes with some downside, and then I'll go over that. So it says up to 6% seller concessions, and what that means is, and you guys are gonna have the, this is gonna be your guys' deal. So when you're drafting up a purchase agreement and your buyers is really tight on cash, they're buying a house for $150,000 and they're barely making 3.5%. That's when the only way to really make it happen for them is to ask the seller, help them out with some of their closing costs and some of their prepaids. What I mean by prepaids is money we collect for taxes and insurance or what have you. So you're able to ask for, you're never gonna, not with us, because we have reasonable closing costs. You're not gonna have to ask for 6% normally unless the sales price is really low. So 6% of the sales price. Okay, that's the max that you can. Normally, you're gonna be at about 3%, depending upon sales price range, 2 or 3 or 4% at the most. So, but you're able to max it out at 6%. 620, credit score, minimum for each borrower. There's a lot of advertisements out there that, people can do FHA with 580 or 560 or 550. It's a lot of, 9 times out of 10, it's not gonna happen. It's more of a marketing ploy. But FHA, the actual Federal Housing Administration, the government who backs the loan, is willing to insure a loan with a 580 credit score. But they say, however, asterisk, you gotta walk on water. You gotta have all these compensating factors. And a lot of times with a 580 credit score, they don't have those compensating factors. So, but again, I've done probably in my career, probably 10 FHA loans that were 580, between 580 and 620. So I'm willing to do whatever we gotta do in order to coach that person and try to get them, to those compensating factors to get them into a house. It's more difficult once you get below that 620 credit score to get a finance. Back end ratio, more lenient. The debt ratios. So right out of the gate, 50%, and that's 50% of their gross income. We can go up to almost 55% debt to income ratios on an FHA loan. Under certain circumstances, again, they gotta have the boxes checked, and to make it work. FHA is only primary residence. You can't buy an investment property with an FHA loan. The only way you can kind of buy an investment property is if, say, you buy a duplex and the person lives in one unit as their primary and rents out the second unit. That's the only way you're gonna get an FHA loan and become an investor or think you're gonna get rental income. If you wanna buy investment properties not occupied as your primary, you're gonna have to go conventional. That's the only way to go. Minimum down payment of 20% too. Max loan amount for FHA right now, about 314,827. That's the max loan amount that you can go through FHA. So, and again, it depends upon certain areas of Indiana, but the majority of Indiana is that 314,827. VA, any veterans in the house? There you go, cool. You ever have a VA loan? You ever have, no? Okay.
I haven't used it
Not even use it? It's an awesome product. I love doing VA loans. I mean, for a variety of reasons. I love helping out our veterans, and it's just a great loan. The number one benefit from a VA loan, well, there's two number one benefits. 100% financing, and there's no mortgage insurance on your monthly payment, no PMI. So those two benefits right out of the gate, I love doing the VA loans. They're a little more complicated during the process. The VA requires a couple more things to happen in order for us to extend out a VA loan. Termite inspection, we need to do, it's a very high level termite inspection. They want to make sure there's no wood destroying insects compromising the structural integrity of the property. So that's required for a VA loan. Well and septic, if it's on a well and septic, got a question?
It says cannot be paid by a veteran. Who pays for it?
It can be anybody but the veteran. It could be the lender, it could be the seller. It's the weirdest requirement ever because you have thousands of dollars of closing costs and the termite inspection costs like $100. So for some reason, VA's like, they're not paying the termite inspection. That's the VA, so it's a weird, and people always get thrown off when they're doing purchase agreements. Because say you're in a competitive offer, you don't want to ask the seller for closing costs. You want to come up with a really strong offer, you don't want to ask that person. Somebody's got to pay the termite inspection besides the veteran. I would say, half the closing costs should be paid by the veteran. That'd be cooler. So well and septic inspection, what that basically means is, and that's for a lot of loans too. If the property's on well and septic, you have to get a water test to make sure there's no bacteria in the water. And 9 times out of 10, if the property's vacant and you take a water sample of that, it's going to fail. If the water's not running through those pipes consistently, there's going to be some sort of bacteria that's going to pop up on a generic water test that you get at your water company. So, that's another inspection septic test that you need. Funding fee. What a funding fee is, that's it right here. It's kind of misconstrued up front. It's not like you're paying it up front. It's based upon your service. You're based off your duty and your usage and how much money you're putting down. It can run from 2.15% to 3.3%. So it's kind of salty. If you're buying a house for $300,000, the funding fee is calculated based upon your loan amount and financing to the loan, unless you want to pay it up front. So if you're financing $300,000 and you're financing 100%, you're financing above and beyond the sales price to pay VA their funding fee. So the VA gets paid at some point, for the loan. But it's more of like the funding fee helps the VA. They have a fund where they put money in case of default because they insure these loans. They back them. So if they go to default or foreclosure, this builds up a fund to help the VA keep the VA whole and continue to extend out financing for their veterans. And again, interrupt me at any time with questions. If I'm droning on too much, just throw something at me and tell me, ask me some questions. Funding fees waived for disabled veterans. So if you have a certain percentage of VA-related disability, there's no funding fee. They don't charge it.
We didn't have any
Yeah.
funding fees,
Mm-hmm.
because my husband was 90%.
Yeah, and he'd be more. I believe it's 30% is the percentage. So 90%. Yeah, he's not going to have to pay that funding fee. Residual income, cost of living expenses are also factored into the ratio / approval with VA, and that some of this is relatively new, and it threw me for a loan that I was doing. Child care expenses. That's the only loan that they'll factor in monthly childcare expenses into the expense ratios to qualify for a VA loan.